This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's get to that chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lack's picture saying, looking for the downloads. Eric, let's start off with crude oil, starting with the EIA inventory.
EIA printed a build of 5.9 million barrels. Now, normally 5.9 million barrels, that's a super big build, and that's super bearish for prices. But in this particular case, it's after last week's 17 million barrel drawdown. That was an all-time record draw. I'm guessing that some of that was actually in the counting, that some oil that either showed up before the count or after the count, something didn't happen. And I suspect that the 5.9 million barrel build was partially a reflection of the fact that last week's drawdown wasn't really quite as big as it was reported to be. Very much to my surprise, the U.S. government refilled 1 million barrels of the Strategic Petroleum Reserve this week. Now, I had seen comments last week indicating that the Biden administration had basically said, look, okay, we're giving up, we're not going to refill it, and they cited market conditions as a reason to not refill it. Now it seems like they are refilling it. So I've got some wrong information someplace. Apologies for that. We'll see what happens next. Cushing, Oklahoma, building a de minimis 159,000 barrels. That's on the back of a couple of really big drawdowns over the last couple of weeks. Gasoline drawing down 2.7 million barrels. Distillates drawing down 1.7 million barrels. U.S. production was the surprise on the board, ticking up massively to 12.6 million barrels. That's up 400,000 barrels from last week. And it's also a new post-pandemic record. We couldn't get above 12.3. There was just one weekly print that hit 12.4, and it was back down to 12.2, and it seemed like we were just unable to go past 12.3 million barrels. All of a sudden, it's 12.6. It comes in a week, though, where we've got some kind of funny reporting with other numbers looking bigger and smaller than they usually do. So I'll be very curious to see if that holds. It's going to be very important to see whether or not the U.S. shale patch is able to continue growing production, especially now that the rig count appears to have peaked. Tape action on this move where there was a big rally move up ahead of inventory. After inventory, that accelerated only for there to be kind of a blow-off top as people realized the market had maybe moved too far too fast. We did see a pullback, but it didn't even get back to the 5-day moving average. We were from about 84.50 or so, got back down to low 83 handle, just above $83. And that's as much of a pullback as we could see before we closed almost back on the highs above $84 at the end of the day on Wednesday. So clearly, this breakout that we're seeing has legs. I do think that we're headed to higher oil prices, but I'm still crossing my fingers for a retest of $77. That's the breakout zone, the 200-day moving average on the continuation chart. If we get a retest of that, I'll lever up my futures position and add to my longs. But at this point, it's probably going to take some weak fundamental news to bring that about because the market's already moved 10% above that level. The slow stochastics are high and tired and wavering. We've got 7 green weekly candles in a row here. We've had a short squeeze after the OPEC Plus news and so forth. It really makes sense that there ought to be some kind of pullback here. The question is how much? Again, I'm hoping we can get to $77. That's where I would add pretty aggressively to my long position. Meanwhile, our friend Dr. Anas Al-Haji says no $100 crude oil in 2023. His thesis is the market's going to stay range-bound, with OPEC and particularly Saudi Arabia setting the floor on prices by cutting production in order to get to the price level that they want. I agree completely with Anas on that. The next side of that is Anas says China is going to act as the swing consumer, if you will, and will start selling down their Strategic Petroleum Reserve before we get to $100 crude oil. And Anas thinks that it's going to be China selling down its SPR that's going to moderate the market and prevent prices from running away. He might be right about that for the rest of 2023, but I'm convinced a day of reckoning will come eventually, and unfortunately, I think it will come in the form of China and Russia deepening their military and geopolitical alliance, and potentially someday if Russia and China, and heaven forbid if they get OPEC on board with them all working on the same team. If they want to starve the West for oil, they will have an almost unlimited ability to do that. So I think that it is entirely possible that China will act as swing producer, but the power that they're going to gain to not act as swing producer, not burn into their strategic petroleum reserve, and allow prices to run higher is eventually, I predict, going to be used against the United States as a tool of economic warfare. So I think we are headed ultimately to much higher prices. How long that takes is a matter of time, but it seems like at least the initial move is upon us.
Yeah, Eric, looking at this oil chart, it's pretty impressive. We have broken out to new highs for 2023 and certainly broke substantial resistance levels. And I'm with you completely on a retest of a retrace. The 200-day moving average is down around that 77. But to me, what's interesting will be simply, will crude oil stop the pattern of making lower lows and lower highs? And at this stage, with a higher high, what I want to see is that a pullback occurs. And when it does, it is bought on dip and really solidified that a new uptrend is underway. If we do have any correction, usually oil has corrections in the $5 to $7 variety. So that $77 level is right in line with what it was a typical correction. If we see that bought on dip, that really puts $90 in play for sometime in the second half of this year. Will be really interesting to see if that gets there, but I am generally bullish. Obviously, I prefer buying dips, so we're going to need some sort of pullback to kind of issue a new buy signal, but the trend is definitely your friend here. Nonetheless, let's move on to equities. What are you thinking here?
Well, the market finally took a pause this week, but the 100-point pullback on the S&P is just noise, in my opinion. If the bearish case that so many of our guests have argued is going to be proven right, that needs to happen pretty soon. And the ride from 4,400 to 4,600 happened so quickly in the blink of an eye that we could be back to new all-time highs just as quickly as we got from 4,400 to 4,600. So I'm still sold on the bear arguments making sense fundamentally, but they haven't been playing out in the market yet. On the other hand, from a seasonality standpoint, crash years in the stock market usually involve a top in August, escalating volatility in September, and then October, of course, is the month that everybody remembers. So if the bears are going to be proven right in a big way in Q4, well, the market top coming in August would make perfect sense. So far, though, I don't see any sign of this topping. What I see is an uptrend that's pulling back just a tiny bit, and it's probably going to move higher. Doesn't make sense to me, but at some point, I think we will see a big bear trend. I'm waiting to see it materialize, though.
Yeah, the window to the upside still somewhat remains open, but let me get to that in a moment. First, let's get Nick in the conversation and just find out where the levels are. Nick, what are you watching here, bud?
So on SPX right now, the spot price is around 44.70. The call wall above is at 45.50, and the put wall below is at 4400. We have an implied move for next Friday's August 18th OPEX at plus minus 80 points. That puts our upper expected move at 45.50, right where the call wall is, and lower expected move at 43.90, approximately right below that put wall. Key resistance is at 45.50, key support is at 4400, 43.50, then 4300. Right now, I'm inclined to think that we're going to see a bit more downside perhaps to that 4400 level, given that we've broken below 4500, as I mentioned last week. I do see a window of weakness into the September OPEX as well, which we'll discuss perhaps next week. But right now, given the earnings season has kind of finished off and we've seen somewhat weak numbers overall, I'm not too impressed. And I do think we see some weakness perhaps before some more strength.
Yeah, Nick, in principle, I agree with you. The chart on page 4, I have the S&P futures, which are trading just slightly above the spot price you were talking about. We're trading right at 4,500, and we're recording this just as the CPI numbers were released. And the first reaction of the market was to strengthen off of the CPI numbers coming in line with forecasts. And the dollar initially did weaken on that. But to me, this 4,500 level on the futures themselves is a very critical level, because if we look at a lot of typical market corrections that would last about a week, they would be about a 100-point variety, and they typically would be bought on dip. And we're right at that critical level right now, that if this was a bull continuation pattern, this was just like a flagging formation, we should see a bull impulse, running this market to 46 or 4,700 on the upside, like Eric was just referencing. But if 4,500 is given out here, if let's say the selling this morning is given back and we start trading below that level, I think 4,400 is too conservative of a short-term low. I mean, if you just use the analog from the February market correction, that was a 300 plus point drop that lasted about a month. If this level is given out, and we're talking about in the next couple of sessions, then it's very likely that the entire month of August could see pullbacks even as low as 4,300 on these S&P futures, where the Fibonacci retracement zones lie. The thing that I'm asking the question, though, is that if we give out 4,500 and start this, have we seen the swing high or the intermediate high of this market? And is this entire advance that's been going on since October of last year over? Now, that is too early to speculate. Like Eric was saying, we could slingshot right back to a fresh new high on a moment's notice if this level turns. But this is a very toppy market, in my opinion, and the breadth is starting to narrow. And so topping formations here can start to form, but it may take much of the rest of the summer in order to really solidify this. So it's certainly going to be a conversation we're going to have over the next coming shows. Moving on, though, to the NASDAQ, what are the levels you're watching on the Qs here, Nick?
On triple Q right now, spot price is 369 approximately. We have a call wall above at 380 and a put wall below at 365. Now, the implied move for the August 18th OPEX, which is next Friday, is plus minus 10 points. So the upper expected move is 379, and the lower expected move is 359. Now we have key resistance above at 400 and then 409, which are the all-time highs. Key support below at 370 and then 360. And again, as I mentioned in previous weeks, I do see weakness coming in tech. I'm more favoring the small caps. But again, as you mentioned previously, if the breadth weakens, we could see a decline in broad markets, and that would coincide with a decline in the NASDAQ as well, and probably a larger decline than the S&P, for instance, because it's more volatile. So, earnings, I found, again, were pretty overall weak if you went into the reports themselves. And I think that Q3 is going to be even worse than Q2. So I don't see really any inclination to go long on a lot of these big tech names. Again, I could be wrong, but I'm sticking with it. And I do think that small caps are the better place to put your money right now.
Nick, the only concern I have about the idea of the small caps outperforming is if Lack was right during the interview that we may be already in the midst of a recession. Small caps have always been the kind of middle America part of the stock market that often is most impacted by a recession. And so, even though the Russell has done quite well in the last 2 months off of those lows, it has been overall a very weak index on a relative basis. And if for whatever reason we found ourselves trading all the way back to 1800 on the Russell, it would certainly start doing some technical damage. So I actually am much more inclined to be more just degrossing equity exposure rather than sector rotating or rotating into different parts of the equity markets. And so I would generally just say taking a risk off is my inclination. Nonetheless, let's talk VIX, though. We finally saw volatility pop right back in. We were trading down even to the 12 handle on the VIX for a while. And we now have seen us break out of that entire June, July trade range. But yet we're not back into that 18 to 20 levels that we've seen through April and May. Do you think that this is a meaningful turn in vol and that vol will be trending higher from here?
Yeah, Patrick, with the VIX at 16-ish, that denotes roughly 1% daily moves in broad markets. And we popped off that, 12 level pretty hard. And thinking about where the market's going right now, looking at the past few days, last Friday, for example, we were pushing at, 45.40 on SPX. And in the latter half of the day, the last couple of hours, we sold off 65 points for about a 1.5% decline from the top. That to me is a signal that we're going to see more volatility. Again, yesterday we saw a very similar move where we declined about almost 1% from the top to the bottom, recovered that, and then sold off into close again. So I'm seeing a lot more volatility in intraday, which to me is indicative of more volatility ahead. It is good for selling premium, but you need to be very cautious as well. And I do think that this forebodes more volatility ahead, which could coincide with a market decline as well. Now on page 7, we have the US dollar index. What are your thoughts here?
Not much new to report here. The dollar has recovered from its temporary breakdown below 100 on the Dixie, as we reported last week. That fake break has so far not brought about a new uptrend or a vigorous new rally. We're just grinding along in the consolidation range.
I find it very interesting where we are on the dollar. Now, while we certainly have seen a substantial retracement of that very ugly July drop, where we dropped from almost 5 points to the downside from that 103.5 down towards towards 99. But one of the interesting things about the current rally is that we basically saw about just over a 3-point bounce higher up towards 103 on the dollar index. What's interesting is that if you look at what happened in the dollar rally back in May, we also rallied about 3.5 points in about 23 days, or roughly 3 weeks. And so this resembles a lot of the same type of a market bounce. And back in May, that rolled over and sold again. And so the question is, are we seeing a similar style scenario where we just had a market react from an oversold condition and it just rolls over and sells? This is going to be the part to really watch here. The way I look at it, the little weakness that we got here after the CPI print that is trading us down to this 102 level, we want to see whether the bulls defend this. If this is a legitimate bottoming formation on the dollar and we are destined to be far more in the trade range of that we've established throughout the entire year, that's sort of 101 to 105 level, then the bulls will buy the dip here. And so we're going to see in the next 1 point lower on the Dixie whether or not that pattern starts to emerge of all dips being bought and the price action gets back towards the top end of the ranges. If Lack is right about the recession call and the risks of that, I still am in the view that the dollar will do relatively well as a safe haven asset during a risk-off impulse. And the real question is, when do we see some sort of a risk-off impulse get underway? Right now, the dollar is not showing any sign of the market being nervous, but will the lows stand here? And the level to watch, in my mind, is definitely the 101 level.
Now on page 8, we have the gold futures chart. What are your thoughts here, guys?
I remain extremely bullish long-term, but I think the correction that gold is undergoing probably has farther to go to the downside. We saw a nice rally after many market participants convinced themselves that surely, after the Silicon Valley Bank debacle, the Fed would never dare to raise interest rates ever again. Well, now that the markets are back in touch with reality and no longer expecting an imminent reversal of Fed policy, gold is hunkering in to weather a monetary policy storm that could last another year and could involve 2 or 3 more rate hikes before the Fed is eventually forced to cut rates despite persistent inflation. I'd also like to point out a charting anomaly which I think is affecting the gold market right now. Normally, gold traders don't give much attention to the contango and backwardation in the market. You have to roll your position forward when the contract you were trading expires, but the difference between the contract that you just traded out of and the one you traded into is like $1 or $2. Nobody cares, nobody pays attention, it's not important. That's because we used to have zero interest rates. But now that we have zero interest rates again, the August gold futures contract, which is expiring, is trading at a $40 discount to the December contract, which has become the new front month contract. So that $40 difference completely changes. The guy who's got the August contract still in his chart is looking at something completely different from the guy who's rolled his contract over to the December contract, and he's looking at a different price. So what does that actually mean in terms of the market? It means technical analysis is going to get a little bit less reliable in the gold market for a while because different people are looking at different charts that say different things. And therefore, the self-fulfilling prophecy aspect of technical analysis isn't working very well.
Yeah, Eric, it was interesting that roll from the August to the December contract did a pretty big gap on those charts. But the interesting thing in general, though, for me, I mean, let's just analyze the December chart on its own so the continuous doesn't factor in. We're trading right back to the June lows. And generally, gold has not really moved strong off of those lows that were established in June. And so generally, gold is in a very distributive pattern, rallies failing, and this usually indicates that there is some more weakness to come. And this kind of fits that bigger intermarket story because gold does best during an easing cycle when things have already broken. And during risk-off impulses, gold tends to behave very much in line with a lot of other risk assets. So this idea that gold may on the short term dip lower and then rally maybe later in the year, if not in the start of next year, I think is increasing probability at this moment. If we do see gold even trade down to 1850 or 1900, I'm going to be paying attention to see whether or not that's where the key lows come in. Finally, I wanted to, though, just talk about two other charts. I wanted to put up the 2s10 US Treasury curve. And what's interesting is that we had a bit of a steepener kick in the last couple of weeks. And the thing is that what drove that steepener? It wasn't a bull steepening. And this is important because a lot of those that have been waiting for this curve to steepen as some sort of evidence that we are in a recession or that the market's about to break. I don't know whether I would trust this one because ultimately this came on a break of the 10s more than it was a bull steepener with the 2s already starting to sniff out the recession. And so when I see that this really starts to move more on a bull steepening basis, then I would put more significance on it. But it is reasonable that minus 1% level that we traded at in throughout July really probably was the low end and probably will be the low of this curve. And we'll see whether or not we finally see some sort of bull steepener kick in to really indicate that the markets are rolling over. Finally, I wanted to touch on the Euro Stoxx 50 index on page 10. And what's interesting is that all of these highs that we saw earlier in the year around 4,400 was quite a significant resistance level that lined up with major previous highs in the past decade. We attempted to, in July, break out to a fresh new high above that 4,400 level, and it was spectacularly rejected. I think the Euro stock will correlate with global equity, and particularly the S&P, but it'll be really interesting to see whether or not any bounces we see here remain below 4,400. If we do, then this could already be marking some of the key tops in the European markets, and it's certainly the thing to watch in the coming week.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.